Docebo has lost 15% year to date as of last Friday, and it was actually down 24% as of last Thursday. And this happened after they made an announcement. As well as on the other side, Delivery Canada or FLT is up around 58% year to date. So we're going to be discussing these two stocks today on this video and what my opinion on both of these are and where I see myself as an investor in both of these going forwards. What's going on, you guys? My name is Daniel, and here on this channel we talk about stock market investing with a focus in the Canadian market. So if that interests you, remember to subscribe down below. And if you want to get access to my real-time thoughts on different stocks when news is released, then check out the Patreon link down below. If you sign up for that community, you will get my buy and sell alerts for both my Wealthsimple Trade portfolio and Quest Trade portfolio, depending on which tier you're in. As well as I talk about stocks that I'm looking into and have not yet bought, as well as my thoughts on big events that happen into companies like Docebo or Delivery Canada. So first off, we'll talk about Docebo and why the stock is down so much. So ever since the beginning of this year, it seems like there's been a sell-off in Docebo. And that's probably because the price has risen pretty high recently, touching all-time highs of around $80 or $82 per share in Canadian dollars. And I think the reason why there's a push up for the stock is A, it's a tech stock, and B, it just IPO'd on the NASDAQ exchange. So there's a lot more investors out there who have an eye on this company, so probably a bit more buying from other investors. And because the stock ran pretty hot all the way up to $80 per share, people are probably taking profits recently. And we got some news last Thursday that there was going to be a secondary offering. And we'll dive a little bit deeper, but the stock dropped from around $70 or $72 per share all the way down to $62 per share. I actually added to my position in Docebo just because I like the company long term. I believe that learning management systems for corporate clients are very critical right now, especially with a lot of companies moving to a work from home model. But even for companies that aren't moving towards a work from home model, it's important to them as well because they save a lot of training costs by implementing a learning management system. Typically, training days consist of a bunch of employees or customers gathering into a room, and they have one teacher there just teaching whatever subject or training people on tools that they need to get trained on. And this can be very costly for a company. However, now with the learning management system, what happens here is lectures are loaded onto the system and employees can watch it at their own leisure at their desk. Usually training sessions, especially if there's customers who are flying in, people have to pay for flights, hotel, food, etc. At a minimum, training sessions, they always offer some sort of food if it spans the entire day. So these are costs that companies are saving, as well as they can also save on instructor costs. The instructor just has to teach a lesson once and upload the video, and it can be available for anyone who wants to learn the content down the road. However, traditionally, the instructor would have to continuously teach a subject every week, month, or whatever cadence these trainings are offered. Enough about why I'm bullish on Docebo, but let's talk about why the stock dropped when the secondary offering was announced. So the secondary offering that was announced was around 3.5 million shares that are being sold by insiders. Around 3.2 million shares, or 20% of Intercap's equity in Docebo, is being sold off. And Intercap is one of the largest institutional investors in Docebo. They hold around 16.7 million shares before the secondary offering. We also have the CEO and the CRO who are selling off some of their equity position. So the CEO is selling off around 273,000 shares, which represents around 18% of his current stake. He currently holds around 1.48 million shares. And then we have the CRO who's selling off 91,250 shares. And his position in the company is around 384,000 shares. So he's roughly selling off around 20 to 25% of his shares. And investors also took it negatively that the company is not raising any money from the share offering. It's purely just insiders cashing out. So I believe that investors saw this trimming from insiders as a very negative thing, thinking that these individuals are cashing out and maybe there's something that we as public investors don't know about Docebo. So ultimately, the stock got punished and it actually dropped down to about $50 per share USD. And the next day, they actually announced the pricing for the secondary offering, which was $49.67 USD, which was a closing price on Thursday. So these insiders got punished for announcing this share sale. And then what happened on Friday was the shares went right back up. I think it rose maybe like 4 to 5%. I saw the ending day price for the Canadian stock is around $67 per share. So, I kind of got lucky on this trade when I bought in at around $63 on Wealthsimple Trade to continue to average into my position. I think that because the general public saw such a drop in Docebo stock, as well as the price of the share offering was announced, people felt more confident going back into the company, and ultimately the stock rose back up on Friday. Another thing that I forgot to mention was that the original number of shares up for sale was 3.65 million shares. However, when Docebo announced the price per share, the number of shares that are being offered now dropped dramatically to 2 million shares. So you can see the Intercap is only now selling about 1.8 million shares. The CEO is only going to be offering 150,000 shares, and then the CRO is only offering 50,000 shares. And they probably decided to revisit the number of shares that they're selling because of how much the stock dropped after the announcement of the share offering. So once the shares rose back up on Friday, I decided not to continue averaging in. I really like the low 60s as a price to buy in, so if we see the stock come down to there, I will continue to average in. Maybe a week or two from now, if it stays in the high 60s, I may average in then. Now moving on to Drone Delivery Canada. So Drone Delivery Canada has been on a tear recently, rising around 58%. And honestly, people were asking left, right, and center, what's going on with Drone Delivery Canada? Like, you can't find any news at all as to why Drone Delivery Canada is going up at such dramatic rates. If anything, Drone Delivery Canada has been a very disappointing investment for investors over the years. And the reason why Drone Delivery Canada has been very disappointing is because they're unable to actually drive revenues from their business yet. A lot of their drones are still in testing phase, and they didn't really find a good way to monetize these drones until recently. When COVID-19 took the world by surprise, the team hit the ground running, realizing there was some opportunity to do some deliveries to remote locations, because drone delivery is basically zero contact. But even with the recent contracts that they got, the amount of revenue that they saw in the past 9 months was somewhere around $63,000. And for a company that's supposedly worth $230 million, that's not much revenue. But I think Canadian investors still like this company just because it's drone technology and it's kind of cool. But the fact that the company continues to dilute shareholders pretty much every half year or even every quarter, this has sent a very negative side to a lot of shareholders who get in and they quickly get out, which drives the stock price down. So this is even worse for shareholders that are holding for the long term. Because when the share price drops down, the company needs to issue even more shares in order to raise the capital that it requires to continue operations. So you've seen some very heavy share dilution when Drone Delivery Canada was trading between like 60 cents and 80 cents. Got some news on January 15th saying that Drone Delivery Canada Corp is issuing this press release in response to a request by the Investment Industry Regulation Organization of Canada to comment on the recent trading activity of its common shares. The company announces that it is not aware of any material undisclosed developments and has no material information or change to report. The company will keep the market informed as required. And the reason why they released a statement is because of the huge run-up in shares, and people are questioning what's happening with Drone Delivery Canada. So here the company is saying that they don't know of any material that's been disclosed to the public that wasn't supposed to be disclosed. And they didn't do anything illegal to cause the share price to go up. But recently the stock has been taking off because there's two stocks that I've seen that are also in the drone space that are doing extremely well. So these two stocks are EHang as well as UAVS. If we take a look at their stock charts, I think EHang really was the first mover of this entire movement. UAVS also had some good news come out when they signed some contracts, so they also picked up as well. And they picked up very quickly. I think people were trying to look for the next drone stock that could take off as well. And Drone Delivery Canada, I mean, it's pretty obvious that they're a drone company, so why don't people just buy into that because it's extremely cheap? So like investors saw this as a penny stock and a drone stock, which are two hot things on the market right now, and ultimately decide to drive the price up by buying quite a bit of shares. And when I realized that Drone Delivery Canada was really piggybacking off of EHang and UAVS's success, I figured that there's going to be a ceiling to this, and I ended up selling my shares at $1.50 per share on I think Thursday or Friday. So I sold my entire stake because I realized Drone Delivery Canada didn't put out any sort of news, or there's no like validation from other sources that this company was doing anything different. And it was just all investor hype because of these two other companies. And I was buying into Drone Delivery Canada around like the 60 to 80 cent level, so I made a fairly healthy gain on this sale of investment. Plus, Drone Delivery Canada was also a very small position in my portfolio, and I didn't plan on continuing to build this up into a larger position. I think for me, if I were to get back into Drone Delivery Canada, I would need the price to drop back down to like the 70 to 80 cent level, and then for them to also have some positive news, like if they're increasing their revenues year over year by a dramatic rate. Right now with $63,000 in revenue and probably running a huge loss on this, this gives me very little confidence that management can continue forwards executing their plans without diluting shareholders extremely heavily. So those are my thoughts on Docebo as well as Drone Delivery Canada. Let me know your thoughts down below in the comments because I'm always interested to hear different perspectives. Maybe I've missed something or maybe you agree with me. Also, if you found this video informative or got some value out of it, remember to leave a like down below. That's all I have for you guys today. If you want to check out other videos and you're new here, check these out here. If you're there, I'll see you there. If not, keep up the grind and have a great day.